Imagine like a rapidly expanding shipping empire.
Right.
They command these incredibly lucrative trade routes, and their order books are full for, the next decade.
Yeah. And ships are basically lining up just to pay whatever exorbitant fees they ask.
Exactly. But then, you look at the company's treasury, and they are deeply, deeply in the red.
Right.
In fact, they're borrowing tens of billions of dollars just to function, because they have to build like 10 new megaports before those ships even arrive.
It's kind of crazy to think about.
It is, and that is the reality of the ultimate tech financial paradox we are exploring today. So, welcome to the deep dive, everyone listening out there.
Thanks for having me.
Of course. Today, our mission is to unpack Oracle's staggering Q4 and fiscal year 2026 earnings, and we've got a great stack of sources for you.
We do. We're looking at Oracle's official press release, their presentation slides, some excerpts straight from the live earnings call.
Oh, and some really sharp financial media analysis too, right?
Yeah.
Including stuff from Bloomberg Television.
Exactly. And our goal here isn't to play armchair CEO or judge if this strategy is good or bad.
Right.
We just want to give you a clear, neutral lens to view how massive infrastructure shifts actually play out on a corporate balance sheet.
Because honestly, the numbers we're analyzing today are genuinely difficult to wrap your head around.
They really are.
Like, how does a company report record-breaking revenues and this unimaginably huge backlog of contracts while simultaneously posting negative $23.7 billion in free cash flow?
It's a huge paradox.
Yeah. So we need to look under the hood of these numbers, translate all this complex financial jargon, and understand what this means for the future of AI and the cloud computing market.
It's a profound look at the actual capital required to compete in the artificial intelligence era.
Completely. So before we get into the massive costs, we should probably first understand the cash that is actively coming in the door.
That makes sense. Let's look at the top line.
Right. So for the fourth quarter, Oracle's total revenue hit $19.2 billion, which is up 21%. And for the full fiscal year 2026, total revenue reached $67.4 billion, up 17%.
Which is, those are top-line growth figures you just rarely see from a legacy technology company of this maturity.
Wait, really? Even in tech?
Oh, yeah. But the real narrative here is the composition of that revenue.
Right. The breakout star was clearly cloud infrastructure, or IaaS.
Yeah.
That segment grew a blistering 93% to $5.8 billion in Q4 alone.
Wow.
Meanwhile, their cloud applications segment, which is SaaS, saw steady growth, up 10% to $4.1 billion for the quarter.
And we should probably break down those terms for anyone listening who might not live and breathe cloud computing.
Oh, for sure. Think of IaaS infrastructure as a service, as renting a raw plot of land. You get the electricity, you get the foundation, but you have to build your own custom factory on it.
Right.
Whereas SaaS, software as a service, is like renting a fully furnished office. You just turn the key, sit at the desk, and start working.
That's a great way to put it. And what's fascinating here is that while Amazon Web Services, AWS, is still the market leader, they generated $37.59 billion in the March quarter.
Right. A massive volume.
Huge. But Oracle's 93% infrastructure growth makes it the fastest growing provider right now.
Let me pause you there, because 93% growth at a multi-billion-dollar scale is basically an anomaly.
It is.
So why is the enterprise market suddenly rushing to Oracle for raw infrastructure instead of going to the traditional incumbents like AWS or Azure?
Well, it really comes down to the mechanical differences in how AI models are trained versus how, traditional software is hosted.
Okay, unpack that a bit.
So when you host a website or a traditional SaaS application, you rely on virtualization. You carve up servers into little virtual machines.
Right.
But training a massive language model, that requires moving petabytes of data across thousands of GPUs at the exact same time.
I see.
If there's even a microsecond of latency between those GPUs, the whole training cluster just bottlenecks.
Oh, wow. So speed is everything.
Exactly.
Yeah.
And Oracle positioned itself really aggressively by building what they call bare metal infrastructure.
Bare metal?
Yeah, highly optimized, low-latency networking architectures designed specifically for these massive GPU clusters. They aren't just selling storage space.
Right.
They're selling the high-speed, frictionless racetracks required to run continuous AI training workloads without any bottlenecks.
Okay, so they anticipated the physical networking requirements of AI before the demand totally spiked.
Exactly.
But to actually service that 93% growth, you need physical servers, right? You need power, you need real estate.
Oh, definitely. And that's where the bottleneck emerges.
Right, because the revenue tells us what happened yesterday, but the backlog tells us about the sheer panic of future demand, which brings us to this $638 billion figure.
Yes. The remaining performance obligations, or RPO.
Yeah. Oracle ended the quarter with an astounding $638 billion in RPO. That is up 363% year over year.
It's an insane number.
It jumped $85 billion sequentially just from Q3 to Q4. For context, financial analysts polled by Street Account were expecting something around $595 billion, so Oracle beat estimates by over $40 billion.
It's just a staggering commitment of future capital.
Mm-hmm.
And, the composition of that backlog is where the structural shift in the tech industry really becomes visible. Well, according to analysis from Bank of America, over 50% of this massive RPO comes from a single player.
Wait, one company?
Yep, OpenAI.
Over half the backlog is tied to OpenAI. That is incredible.
Yeah, but the structural shift I mentioned is actually the most fascinating part of these documents.
Okay.
$75 billion of these large AI contracts involve customers utilizing a BYOH model.
Bring your own hardware.
Exactly, where they actually prepay or physically supply the GPUs themselves.
Right, and here's where it gets really interesting. To put that into perspective for everyone listening, imagine a massive global shipping port. Right?
Mm-hmm.
The Port Authority owns the prime coastal real estate, the deep water channels, but demand is so insane that a major shipping company calls and says, look, we know you don't have enough cranes to unload our ships,
right?
So we're going to buy the $50 million industrial cranes ourselves, ship them to your port, and bolt them to your docks just to guarantee our cargo gets processed. Or back to the restaurant analogy.
Oh, yeah, the restaurant.
It's like a wildly popular restaurant that is booked out for years. The RPO is the total value of all those future reservations.
Exactly.
But these customers are not just reserving tables. They're actually buying the ovens and giving them to the restaurant just to ensure they get their meals. Why would a company like OpenAI basically buy the equipment for Oracle?
Well, because the specialized hardware, specifically NVIDIA GPUs, is literally the most constrained resource on the planet right now.
Makes sense.
And building the data center shells to house them is incredibly capital intensive. So by having customers prepay or physically supply the GPUs, it substantially reduces the amount of upfront capital Oracle has to raise itself.
So it effectively offloads the hardware depreciation risk onto the customer.
Precisely. And this is totally crucial for Oracle's financial health.
Right.
By shifting that upfront capital burden, Oracle management noted on the earnings call that they can maintain their targeted 30 to 40% profit margins on these infrastructure contracts.
Wow. Okay.
Yeah. They're preserving their margin profile while securing guaranteed long-term rental income on the facilities they're building.
That makes a lot of sense. So that clarifies the infrastructure side, but all this raw computing power eventually has to, generate value.
Oh, absolutely.
And it is being deployed by enterprises globally right now. The sources highlight the multi-cloud AI database, which grew by 404% in Q4, making it Oracle's fastest growing business ever.
Yeah, and this is where the infrastructure translates into real application.
Right.
Customers are taking their proprietary historical data, which honestly has often just been sitting siloed in Oracle databases for decades. Yeah. And they're compounding it with AI inferencing.
Okay, let's drill into the mechanics of that. What does compounding decades of data with AI inferencing actually look like functionally? Because I want to avoid just using buzzwords here.
Totally fair. So look at Claro, the major telecommunications provider in Latin America that was mentioned in the sources.
Okay.
They have 30 million subscribers. Historically, if a cell tower goes down, a traditional database just logs the outage.
Yeah, and then human agents deal with the massive flood of angry customer calls.
Exactly.
Oh.
But by utilizing Oracle Cloud Infrastructure and their AI data platform, Claro isn't just bolting on some generic customer service chatbot.
Right.
They're allowing AI to inference against years of network maintenance logs, real-time weather data, and specific customer billing cycles.
Oh, I see. So the AI can instantly correlate a hardware failure with the specific billing profiles of the affected users.
Exactly. It identifies patterns instantaneously.
What?
It knows which high-value enterprise clients are connected to that specific tower. It references their past service complaints, and it can automatically execute a customized service credit or reroute their traffic before the client even realizes there was an outage.
That's incredible. It basically turns passive historical data into an active, automated operational engine.
Precisely.
And the documents also mention the UK National Health Services and QXO, which is a major U.S. building products distributor, utilizing similar architectures.
Yep.
Plus, Oracle Health is rolling out an AI version of the Cerner patient care system, and they expect this integration to push the health business to double-digit growth in fiscal year 2027.
Which really demonstrates that enterprise AI is moving out of, isolated testing environments.
Right.
It's moving into the core operational nervous systems of massive traditional industries. Healthcare, telecom, logistics.
Before we move on to the sheer cost of building this nervous system, I do need to share a quick note here. All the information and analysis we discuss here is purely to help everyone better understand the market and does not constitute investment advice. Investing carries risks, so please do your own research or consult a professional financial advisor before entering the market.
Always an essential reminder, yeah. Especially given the volatility and scale of the numbers we are discussing today.
Exactly. And speaking of those numbers, I want to challenge the narrative coming out of this earnings call for a second.
Let me go for it.
We have these great examples like Claro, but if I'm an enterprise CIO, ripping out my legacy operations and handing them over to an automated AI system is terrifying.
Oh, absolutely.
Are traditional businesses actually ready to integrate AI at this scale?
Yeah.
Or is this still heavily concentrated among, the early adopter tech elite?
It's a really critical distinction to make, and the earnings call commentary actually addressed this friction directly.
They did.
Yeah. Management acknowledged that over the last year, there were delayed decision cycles.
Okay.
Customers were really struggling to separate genuine operational utility from Silicon Valley marketing hype.
Right, they were facing integration paralysis.
Yes, exactly. However, what has fundamentally shifted, particularly in the mission-critical enterprise software space, is a realization that AI integration is no longer a luxury upgrade.
Interesting.
Customers are recognizing that having AI securely inferencing their proprietary data within their existing SaaS solutions is mandatory.
Mandatory for modernizing operations.
Modernizing operations and protecting themselves from more agile competitors. The tone of the call really suggested it has shifted from a discretionary experiment to a defensive imperative.
And that defensive imperative is clearly driving unprecedented demand. I mean, the $638 billion backlog proves it.
It really does.
But scaling from pilot programs to full deployment requires physical infrastructure that, frankly, does not exist yet, which brings us right back to our opening paradox.
The sheer financial weight of this expansion.
Exactly. Okay, let's unpack this. Free cash flow is negative $23.7 billion for FY26. Capital expenditures, or CAPEX, which is the actual cash spent on acquiring land, pouring concrete, installing servers that jumped 162% to $55.7 billion.
Insane numbers.
And the net cash outlay for CapEx in FY26 was $48 billion.
And we really must recognize that this is just historical spending. The forward guidance is significantly more aggressive.
Right. Because for fiscal year 2027, Oracle is projecting a net cash CapEx outlay of around $70 billion.
Just massive.
To put $70 billion into perspective, that is roughly equivalent to the entire annual gross domestic product of a small European nation.
Wow.
Or the cost of building multiple state-of-the-art semiconductor fabrication plants from scratch, all spent in a single year.
It's hard to even conceptualize.
And to support this, they expect to raise approximately $40 billion through a combination of debt and equity financing, which includes a $20 billion stock sale.
Right.
They're executing this while guiding for FY27 total revenue to hit $90 billion, which is a 34% increase. And Q1 FY27 revenue is expected to grow 27 to 29%.
So revenue is accelerating at a historic pace. But the capital required to build the factories generating that revenue is just outstripping it entirely.
Exactly. And if I'm looking at this strictly as an analyst, seeing management plan a $20 billion stock dilution and take on massive debt while free cash flow is deeply negative, that looks incredibly precarious. How sustainable is a spending spree of this magnitude?
Well, that is the primary source of skepticism emanating from the financial media right now.
I bet.
If you look at the analysis from Bloomberg Television, they dissect this into two distinct, massive hurdles.
Okay, what's the first one?
Financial discipline.
Meaning, can they keep the capital markets calm while asking for another $40 billion?
Precisely. They already raised $43 billion in debt, and $5 billion in equity in fiscal 2026. Now they're returning to the well for another $40 billion.
Right.
Institutional investors eventually start to question whether the ultimate long-term yield of these AI workloads will truly justify the sheer volume of new capital being raised.
And all the resulting interest expenses.
Hmm.
Okay, and the second hurdle Bloomberg highlighted.
Logistics and physical constraints.
Oh, building the actual data centers.
Right. Financing a data center is complex, sure, but physically building gigawatt-scale data centers on time is a monumental engineering challenge.
For sure.
We are talking about pouring millions of tons of concrete, securing highly specialized high-voltage transformers, and laying thousands of miles of fiber optics.
Right.
But the absolute biggest bottleneck, securing the electricity.
Oh, wow. Yeah, bringing online almost 1 gigawatt of computing power in a single quarter, which is what they are attempting, that requires the electrical equivalent of powering a medium-sized metropolitan city.
It does. And the traditional power grid simply wasn't designed to support sudden, localized power draws of that magnitude.
No, of course not.
The physical limits of the global power grid are rapidly becoming the defining constraint of the AI revolution.
So how is Oracle attempting to mitigate a bottleneck that massive? You can't just build a data center and, hope the local utility company can find a gigawatt of spare power.
You really can't. Which is why the sources indicate Oracle is fundamentally altering their data center design.
What are they doing?
They are designing massive facilities intended to be powered by on-site natural gas fuel cells.
Wait, really?
Yeah, by generating their own clean electricity directly at the data center level, they can bypass the crippling multi-year delays associated with waiting for municipal grid upgrades.
Wow. So they're effectively becoming their own private utility company just to guarantee their servers turn on.
Basically, yes.
That perfectly illustrates the sheer scale and the high stakes of this infrastructure race.
It really does. I mean, from a purely analytical standpoint, Oracle is executing a masterful financial strategy by using customer prepayments to buffer their margins.
Right.
But transforming $70 billion of capital into functioning electrified gigawatt data centers in a 12-month window, that's an operational tightrope with zero margin for error.
Absolutely zero. Let's synthesize all of this for everyone listening. There are 3 critical takeaways from this deep dive into Oracle's Q4 and FY26 financials. Number 1, unprecedented infrastructure velocity. Oracle's cloud infrastructure segment is nearly doubling year over year.
Driven by that architectural advantage in hosting low-latency, high-performance GPU clusters for AI training.
Exactly. Number 2, a paradigm-shifting backlog. The $638 billion RPO is heavily fueled by AI giants fundamentally altering enterprise economics.
Model, customers are underwriting the capital risk of Oracle's expansion.
And number 3, the staggering cost of ambition. Meeting this demand requires capital expenditure projections of roughly $70 billion next year alone, necessitating tens of billions in new debt and equity financing while navigating deep negative free cash flow.
Which brings us to a final, broader implication to consider.
Go for it.
This raises an important question. We spent a lot of time discussing how customers like OpenAI are prepaying billions and supplying their own hardware just to secure space, right?
Right.
Historically, the cloud provider held all the leverage. They own the land, the servers, and the infrastructure.
Yeah.
But as these AI megatenants increasingly fund the construction and supply the most valuable component, the silicon, it forces us to ask, are we witnessing a shift in the balance of power?
Oh, wow.
If the tenants are buying the cranes and paving the roads, does the cloud provider eventually stop being a technology platform and simply become a highly paid commercial real estate manager for a handful of AI monopolies?
That is a phenomenal shift in perspective to ponder. When the customer is financing the factory, who really controls the means of production?
Exactly.
Thank you so much for joining us on this deep dive. Keep questioning the numbers behind the headlines, keep looking under the hood, and, we will see you next time.